The next internal control activity is to divide responsibility for related transactions. So divide that responsibility to one or two more individuals. This is called separation of duties. And this ensures that one person can act as a check on the other to prevent fraud or errors. So in a lot of cases, if employees have purchasing power, so I can purchase something for on behalf of the company, or I have a company credit card or a purchasing account. I can purchase items. I need to provide receipts for those items, and someone, at least one other person, sometimes two, has to approve my purchases. They have to prove that, yes, I have a receipt, both a receipt of purchase and a receipt that I received the item. And that's a checks and balances thing. Another way that we can sometimes provide separation of duties is requiring more than one signature for a check for certain amounts. So no check over $1,000 can be written to pay any invoice without two signatures. That's also a common checks and balances thing that is put in for internal control. Then we can also have technology. So cash registers, computerized cash registers that have an electronic file of each sale, having an electronic time clock that records the exact time employees work instead of having a pencil time card or something, having scanners which limit access to authorized individuals. So if we have ID cards that limit our access to various amount of things. For example, I have to use my ID card to use the copier in our office. So it records that I am using the copier that I have access to, I'm authorized to use that copier, and then how much I'm using of the copier's resources. Then we perform regular and independent reviews, both internal and external. Our external auditors should not be directly involved in the activities of our company. So we should use if we're paying for accounting services, we should use a different company to audit. Most companies are required to be audited once a year. So the SOX Act requires that an internal or an independent audit is done every single year for companies that are traded on the New York Stock Exchange. When we're looking at technology fraud and internal control, it helps us when we have more technology, we have more extensive testing of records, we have a lower risk of processing errors from communication issues, from writing on things. We have increased e-commerce in that we have online buying, and we have evidence that order processing is happening because we have online or computerized orders. Some of these processing errors that used to happen before we were using computers in almost everything that we do can be done just in handwriting. So is that a 2 or a 7? And do I have to read another person's handwriting and make informed decisions based on that? So that's one of the processing errors that has been reduced. There are limitations of internal control policies, of course. We still have human error. We have carelessness or misjudgment, or we didn't know what the rules or the regulations are. Um, Actually, 2 summers ago, there was a school system in Iowa that was charged with payroll accounting fraud, and they received a lot of fines from the IRS because their payroll accounting records were incorrect. And one of the reasons is because the person that they had processing payroll hadn't been properly trained. And didn't know that certain reports had to be filed at certain dates, so had never filed any reports with the IRS that were required. Then we have human fraud. So human fraud is the intentional defeat of internal controls for personal gain. We talked about the fraud triangle in chapter 1, that we have opportunity, financial pressure, and rationalization. Internal control is intended to reduce that opportunity. If I have to go through checks and balances, if there are computerized controls, if there are access controls that limit my opportunity to access cash or other resources to steal them, then all the financial pressure and rationalization isn't going to help me get past those internal controls. And then last, we have the cost benefit principle. So the cost of implementing and maintaining internal controls shouldn't exceed the benefits of having those internal controls. That's not always the clearest relationship to express, because sometimes it's hard to say, well, what is the benefit of having these internal controls in place? Sometimes it's not measurable because you can't say, well, we know for a fact that we have benefited by reducing any ability for employees to commit fraud. So that's what our cash benefit is that we didn't have any fraud. Well, how do you measure what your potential fraud could have been? Next, we're going to talk about cash and cash equivalents. So cash. We should have an effective system of internal control that protects both our cash and cash equivalents. When we should have 3 basic guidelines on those. Handling cash is separated from the record keeping for cash. Cash receipts are promptly deposited in a bank, and cash disbursements are made by check. So anytime that cash goes out, we do that as a direct withdrawal or with a physical check. This way, there is a record of that cash disbursement. It is easy to say, I received $20 in cash and then I paid that $20 in cash back out without providing any record that that transaction actually occurred. So one of those controls is to make sure that if we receive cash, we deposit it all in a bank. And then when we pay things out, it's not paid with actual physical cash. So cash, cash equivalents, and liquidity. So cash and cash equivalents are called liquid assets because they can be easily used to pay our current liabilities. Liquidity is how quickly can something be turned into cash, or how liquid is it? Well, cash is already cash. Cash equivalents are short-term, highly liquid investments that are readily convertible to a known cash amount and close to maturity date and not sensitive to changes. There are a wide variety of investments that can fall under this short-term investment rate, but usually they are 30-day to 60-day investments. So we would put it in, we get one of the benefits of having cash equivalents is then instead of just having cash in the bank that is not getting interest, on cash equivalents, we're going to be gaining interest. Even if that interest is a nominal amount, it's still an amount that we're earning on that cash. But we don't want to tie up our cash for so long in long-term investments that we don't have access to it to pay our current liabilities. So that result is short-term investment. When we look at cash management, our goals are to plan cash receipts, to make cash payments when due, and keep a minimum level of cash necessary to operate. So that's where we want to have some of our cash invested in ways that we can still have access to it rather quickly, but we don't want to have all of our cash just sitting in the bank waiting to be paid because then we're not earning any interest on it. So when we're looking at cash management strategies, this is how fast can we collect from our customers. So our collection of accounts receivables, which we're going to talk about extensively in Chapter 7. So how can we encourage our customers to pay us faster? Then we have those credit terms like we talked about in Chapter 4 of we would do 210 and 30 where we encourage them to pay in 10 days. How can we delay payments of our liabilities so that we're paying them on the last passable date? We don't want to pay them so fast that we didn't take the time to earn interest on that cash, but we do want to pay them in a timely manner so we don't have any penalties for paying late. We only want to keep our necessary assets, so this includes only our necessary cash. So we're going to plan our expenditures and invest any excess cash that we have. There is a mathematical formula that looks at how much cash should we have on hand and how much should we have invested, but we will not be talking about that mathematical formula in this chapter.